As Chris said, I'm Managing Director of Antipodes Partners, the manager. I also wear another hat, that's as a Director of APL, our listed investment company. They're quite distinct roles, which I'll talk a bit about in a moment. So we have two listed investment offerings, two complementary offerings, I'd say, as you've already heard today. One is a listed investment company, one is an active ETF. Why did we launch both, and why did we launch any listed offerings to start with? Well, effectively, when we started Antipodes, we noticed what we would describe as a secular shift going on. Investors increasingly favouring investment via a listed offering. Now, it's just starting, but it's growing quite quickly. It's pretty much as you would expect, because being on market does facilitate ease of access, and we wanted to be part of that. As a manager, we want to make our strategies available to all segments of the market, and so from an early stage we made available both our flagship global strategies, long short and long only, in listed format. On the left, the listed investment company; on the right, our active ETF. Both offer access to a diversified portfolio of global companies. Both have proven track records, and both are managed according to our pragmatic value approach. A little more about Antipodes for those who don't know us. We were formed around 4 years ago and have grown quite quickly to manage over 9 billion today. Whilst a young firm, we do have a very strong pedigree, having been founded by Jacob Mitchell, the former Deputy CIO at Platinum, together with a number of his former Platinum colleagues. We now are over 25 plus investment professionals based in Sydney and London. We are strong believers in alignment with our investors, be they shareholders in our LIC or investors in our ETF or in our other offerings. And we have 20 million of our own firm and individual money invested in our listed offerings to date. We are a value manager, and as many of you will know, value has been quite a difficult place to be in recent times, and I'll touch on that in a moment. We are, in all our strategies, up in absolute terms since inception, but lagging in recent times, a very strongly performing index driven by quality and growth companies primarily. Before I move on, let's quickly summarise the view from our investment team. As at the beginning of July, the US has had the longest economic expansion since the Civil War, I suppose, and the longest bull market on record. That's been driven and characterised by things like quantitative easing, record low interest rates, credit growth, buybacks, disruption, etc. The question is, can the US accelerate further from here? Industrial data recently has been mixed, and the US is already running a fiscal deficit of 3.5% of GDP. We think there's much greater fiscal flexibility elsewhere in the world, and hence the US economy will be relatively weaker than other parts or other economic blocs. In particular, the domestic-facing part of the US market will be particularly vulnerable, and we describe the tailwinds from stimulus fading and turning into headwinds, actually, and competition on the back of those low interest rates fueling, investment really rising and creating issues there as well. Likewise, we see the US dollar at risk in the face of a rate cutting cycle. So we think quality and growth can still perform, but would caution against investing in quality and growth companies at any price. And we're really adopting the mantra of looking for structural growth opportunities in less obvious parts of the market. You can find out a lot more in our most recent quarterly report, which is available on our website, or talk to your Pinnacle representative, who will be happy to share a copy with you. Let's look at quality/growth and value a little more closely. This chart here really illustrates the style cycle, if you like, growth versus value over time. Above the line, value outperforms growth. Below the line, growth outperforms value. And as you can see, we're at quite an extreme. In fact, the most extreme over the last 100 years, which includes plenty of previous stock market events like the Great Depression, the Nifty 50 bubble, and more recently the dot-com bubble around the year 2000. I think the key message of this slide is really about diversification. It's important for all investors to think about blending not only different asset classes, or for a manager like us, stocks, sectors, countries, geographies in a portfolio, but for investors choosing managers, also choosing managers of different styles. It's very hard to forecast ahead of time what style will outperform, and hence it's best for most investors to really have a blend of investment styles in their portfolio. Now let's look a little closer at our listed investment offerings. Two columns here on the left, listed investment company, APL, on the right, AGX1, our active ETF. Now, a lot of the differences between these two structures really stems from the legal structure. One is a company, one is a trust. As a company, there's a separate layer of governance, and this comes to my point earlier about having a different hat. It's a majority independent board. It acts like a company. We can take at board level decisions around capital management, which are very important in terms of the returns generated by the company, expressed as an NTA. Of course, there's a share trading price that sort of deviates from that NTA, but really, in terms of the NTA itself, that's influenced not only by the underlying portfolio performance, but also the capital management decisions taken at company level. So it's very important, we believe, to observe the difference between manager performance and company level performance. That also leads on to differences in income and tax. As you can see, a listed investment company has the ability to smooth income over time. It's tax paying, so any dividends will come with franking credits attached. On the other hand, an active ETF being a trust structure, it's dealt with on a flow-through basis, and all distributions on an annual basis include any income and all realised capital gains. So income tends to be much more lumpy, if you like, versus a listed investment company, most of which aim for consistent income levels through time, through that smoothing ability they have as a company. The choice of which one's better is really a matter of investment or investor preference. Digging down into each one a little more closely in turn. Firstly to APL. We IPO'd in 2016, raising a little more than $300 million at the time. We were one of the last LIC IPOs to include an option attached. And I must say, what's happened in the industry since, as Chris alluded to earlier, has been positive, I think. The options, dilution from options, certainly can add to returns for investors at IPO, but it does confuse the performance track record when you look back in history. Around 90% of the options in our case were exercised, and together with portfolio performance, this has helped grow the market cap of the company to 550 million or so today, which makes it, or which helps make it one of the 10 most liquid LICs on the ASX. We look at the NTA and share price performance since inception. Firstly, the NTA in light blue and the share price in dark blue. And as already mentioned today, share price can move and trade, if you like, at a premium or discount to NTA through time. My comments on capital management earlier, the options expiry in our case contributed to an 11-cent impact on the NTA. You can see that sort of in the late October timeframe when the options finally expired. We've also paid 2 dividends since inception, contributing to 7 cents being paid out of the company. Clearly, the share price anticipates those capital management events. Hence it traded down leading into October 18. Since that time, we've seen the discount increase somewhat, which is very much a focus for us, and I'll talk a bit more about that in a second. If I open the lens and look a bit more broadly at all global equity LICs, so the peer group, if you like, you can see that across the sector, there's been a general increase in the discount to NTA across all global LICs. The important question is, for each company in the sector, what are we doing about it? The way I'll sort of address that is to just describe how we're trying to be a best-in-class LIC. Firstly, at the top of the chart there, portfolio performance. Ultimately, share prices for LICs, for any company, really reflect the demand and supply of shares, more buyers than sellers. And that's primarily driven, we believe, by confidence in the manager's ability to outperform. So as I said before, we're in our own investment cycle, being a value manager, facing a bit of a tough time. We need to communicate as well as we can, as frequently as we can, about how we see the prospects of the portfolio. We've been doing a lot more lately on that regard, but I can assure you the investment team at Antipodes is 100% focused on driving returns from our underlying portfolio. In terms of capital management, things like dividends, developing a reputation for delivering consistent dividends over time. We're a young company, but that's something we're aiming to achieve too. And then we can take decisions like we did last week in announcing an on-market buyback. And the board now has made that announcement as of last Friday. And we think the portfolio, or not the portfolio, the NTA and the share price does not reflect that NTA closely enough. We'll take advantage of the share price and buy back shares over the next 12 months, up to 10% of the shares on issue. Shareholder alignment, not only is that evidenced through actions of the board, but also of the manager and affiliates. So we've also put out some announcements recently around the level of manager buying. So the manager and individuals associated with the manager now account for enough shares to make us a top 10 shareholder in APL. It's a strong demonstration of alignment, we believe, with shareholders. Transparency, communication and market support. Together with our colleagues at Pinnacle, we're really doing a lot more in terms of engaging with the market, with researchers, with brokers, with advisors, webinars, and doing a lot more there, we think, to help communicate how we see the underlying portfolio, the value that lies within, and hopefully that will help also contribute to a diminution in the discount. Now, if I just move to AGX1, the active ETF, that's our newest offering, if you like, launched in November 2018. Its underlying investment portfolio is our global long-only strategy. It's a very new category, as Chris said, but we think it's a very exciting category to be involved in. There are a lot of things to like about this product innovation, if you like, or this structural innovation of active ETFs. What's different from an LIC? Essentially, it trades more or less at NAV through time. It's an open-ended vehicle. It doesn't have that cycle of premium discount to NAV as you would see with a LIC. Many people find that attractive. There are trading strategies around that. There's opportunities for additional return in the LIC world because of that. On the active ETF, it's more or less a straight through to the underlying portfolio. So that appeals to other people. Similar to the LIC discussion, we're really trying to be best in class in the way we deliver our active ETF. Antipodes was the first manager within the Pinnacle Group to offer an active ETF, and we've worked very closely with our Pinnacle colleagues to do everything we can to ensure we have, for example, best-in-class market making. As the vehicle is trading through the Australian trading day, some of the underlying assets are not open for trading. So, for example, if we're holding shares in the US or Europe, those markets are closed, so we need to approximate the value of those shares. So we've got a very sophisticated proxy setting regime, and from all the feedback we've had from intermediaries and others who have looked a little closely under the bonnet, we're very much best of breed in that regard. There's no legacy tax issues with our ETF. We're not a feeder fund. It's a portfolio of direct assets, which we also think is an advantage. And similarly, market support, communication, we're doing a lot in terms of helping grow the sector as well as promote our own strategy in this regard. Overall, listed investment offerings for Antipodes are a very important part of our future. We think they'll grow quite strongly in time, both across the industry and for us, and we're truly committed to it, as evidenced by more than 20 million of our own money invested in those strategies. Thank you for your support.